Before this video begins, guys, allow me to apologize just for the structure of how things will be. I've recorded this video on a whim. It was after much due diligence, and while yes, a lot of stuff I'm saying will be referenced in the description down below, there'll be links to articles, the news interviews, the data that I talk about. A lot of it is off of a free flow thought. I'm just speaking as the words come to me, and I just have a few notes that I'm referencing. I'm just speaking into this kind of like I would a podcast and not really production-esque video. I want to just speak about the events that are going on today. So if the video does seem a little bit unorganized, and maybe jumping from place to place, please let me apologize in advance. And we just want to hear you guys' opinions on what's going on recently in the markets. So if you have the time, just put this video on in the background, go about your day, do what you're doing, and just hear what we have to say about the current market conditions and the market climate. We'll be speaking specifically on what's going on with GameStop, and especially about what's happening with Robinhood and these brokerages and their actions today in halting GME trading. Thanks for checking in, and we hope you guys enjoyed the 100% of shares on the market. Shorters were somehow able to short more shares than are available. Now what that means is, should shorts have to cover their position, since they short more than the entire availability of shares on the market, it will be almost impossible for them to cover, at least without causing what's known as a short squeeze, the price being raised incredibly high in a short period of time. Now the reason why that may happen is because when these shorts are trying to cover, once again, because their short position, aka the amount of shares they borrow to short, is greater than the overall amount of shares that are available, when they go to buy, there will be a lot of demand, but very limited supply. So that will cause bidding for the price to be almost astronomical. Now, if you want points of reference, you can go back and look at the short squeezes of Blue Apron or Volkswagen to see something very similar. While those were short squeezes, the circumstances under which they happened were very different from what we're seeing with GameStop. GameStop was brought to the attention of most of the people, at least on social media, through a user on Reddit known as DFV. What he pointed out was not necessarily the short interest or the metrics of the short interest to the users, but the value play that was in GameStop. You see, because there were so many people shorting GameStop, it drove the price down artificially to a level that didn't represent what the company was worth. At that time, when he entered, I believe about 2 years ago, it was trading at around $3 to $5, within that range. Now, many believed if you assigned it a fair value, that stock would actually be worth around somewhere between the ranges of $10 to $15. And that's exactly what DFV had in mind. He posted a little bit of due diligence on the Wall Street Bets forum, and as his closing statement, and his due diligence was actually really interesting. He points to a lot of the financials of GameStop, the direction that the company can move, and just the overall good health that the company was in. Yes, they had declining sales, but with a new console cycle, with their move to the e-commerce platform, and just with the total amount of cash they had on hand, it didn't look like GameStop was about to go bankrupt anytime soon. So aside from that, he pointed out the short interest towards the very end of his due diligence, or his write-up of why he thought GameStop should be trading higher in 2021. Now many agreed with him. Actually, many famous and respectable investors agreed with him. If any of you have seen the movie The Big Short, the person that Christian Bale portrays, Dr. Michael Burry, is known to be one of the best value investors on Wall Street, even though he likes to portray himself as being secluded from and not attached to all the becomings of what people do on Wall Street. But nevertheless, he's a great value trader. I had the same idea about GameStop, and he entered a position as well, although I believe it was approximately 8 to 11 months before DFV entered. Now, what we started to see since that point in 2019 is Jeff Cohen, the CEO or former CEO, founder of Chewy, a now multi-billion-dollar business. He also saw a lot of interest in GameStop and saw that it had a lot of potential if he was able to make it to the board and change around the management of GameStop. You see, he had a very futuristic outlook on what GameStop could be. GameStop had long been the center for, of course, gaming, and now with the recent shift of gaming to moving online, to PCs, to Steam, they lost a lot of what made GameStop their revenue. GameStop was relying heavily on being able to buy in and selling retraded games. Because a lot of games and a lot of gaming in general had gone digital, that part of the business suffered. He wanted to come in, he wanted to change the entire e-commerce platform and make GameStop almost a hub of gaming, as it should be. You know, they wanted to make it so you can also have PC gamers there, etc., etc. He basically had a way or a plan to turn GameStop around. Many saw this as a good catalyst for GameStop. And we saw earlier this year, in around the first 2 weeks of January, many value investors, big money, started pouring into GameStop. That's when we saw some shorts exit GameStop, have to cover, and drive that price up to about $38 before shorted down. Since then, there's been a lot of price volatility, and I don't want to get into that. What I want to get into is what happened with the brokerages these past 2 days. So let's fast forward. Now, GameStop touched an all-time high of around $4.50 this afternoon. Now, immediately after that, Robinhood publicly tweeted that they would not be allowing GameStop to be traded on their platform. Amongst other shorted tickers, they said that GameStop would be way too volatile for retail traders to handle. Now, I'm going to break this down as best as I can, and this may be a bit disorganized, but I ask that you have some patience and just listen to what I have to say. If you have some time on your hand, maybe put this on in the background, take a seat, and let me just guide you through what we know of the events thus far. Robinhood is a brokerage that came out with this idea of commission-free trading. They honestly revolutionized the game, and before them, many brokerages weren't doing this. So immediately they attracted common man, people who are like you and I, maybe work a 9 to 5, who want to invest in their free time and learn about the investing world. So that group of traders, retail traders, are usually prone to a lot of risk because they may not do the same amount of due diligence or learning on where to buy, what stocks may appreciate in value, and what assets to use to accrue wealth. Now, Robinhood completely ignored these factors. As a matter of fact, that's prevalent just by the fact that they had options trading enabled. Now, options trading, although it may be common practice today, just go back 1 or 2 years, and you saw many brokerages saw the fact that Robinhood was allowing just any person to have options trading enabled to be just absolutely horrendous. The reason being is that options is so volatile, they can blow up your account within a matter of minutes if you don't know what you're doing. So with that established, we already see that Robinhood does not care about risk tolerance when it comes to their own users. Now, Robinhood has had a lot of bad history on its books. There's been many a times when people have been unable to sell because of Robinhood outages or just due to bad coding from Robinhood in general. Now, I want to point out the fallacy of what Robinhood has done by disabling the ability for people to trade GameStop, AMC, and other heavily shorted stocks that were rising the past few days. Robinhood had no qualm when people were carelessly investing into Nikola and it went under. When people were speculating heavily and investing on Hertz, Purple, tickers like that which were obviously going under and depreciating and falling rapidly. They had no sort of qualm with mitigating that risk, but warning investors and traders then that those tickers may be dangerous. Yet, when a ticker is seeing huge upside, that's when they're concerned about risk? That seems a bit fishy. So those red flags have been raised already, right? The fact that they're trying to control risk when a stock is on the upside kind of shows that there is something fishy going on in the background, especially since we haven't seen them do this with other stocks that have gone on rapid upsides, such as Tesla in recent times, Plug, or other stocks that have either been halted on the rise. So the reason many speculate that Robinhood stopped this from going through, stop their clients, people who use their platform to be able to trade this, was because their largest customer, Citadel, a firm that does a lot of the options writing, does a lot of the order processing for Robinhood, that their largest customer had a vested interest in Melvin Capital, one of the companies that was heavily shorting GameStop. They had given $2.5 billion loan to Melvin, and Melvin had lost that in just the interest fees and the penalties that came with shorting GameStop this week alone. So Robinhood had to make sure that its biggest customers stayed afloat, as long as its biggest customers' investments, aka Melvin Capital and other firms. Now, many may be asking, all right, the short squeeze may be happening, right? These companies may be getting shorted out of their position, but why would Robinhood care? Sure, maybe Citadel and Melvin will have to absorb a few losses, but that shouldn't affect Robinhood in the least bit. Well, it does when you consider the sheer magnitude of what this squeeze was. I want to direct you to a few posts on WSB, which I'll be linking down below, in which many people saw, and this was not just on Robinhood, this was on other brokers as well, where the bid-ask spread of GameStop shot all the way up to $5,000. Some people were getting orders filled up to $5,000 for a GameStop share. What does that imply? Well, for one, that implies that there has to be buyers at that price. At all those market order fills that I'll be including down below, the screenshots of those bid-ask spreads, etc. Those were prevalent right before the halts. What that implies is that the bid-ask was shooting up so much, right? That the demand of the stock was shooting up so much that it far exceeded what the stock price was available to us in the public market, right? For around $450. That implies that before this squeeze even happened, right? And as of now, as of the uploading of this video, the squeeze has, many say, not been squeezed. It hasn't occurred yet. That means that there was such a demand for that stock price that it shot up to about $5,000 for some buyers. Let's say the short squeeze does happen. If we look at outstanding shares, we know there's right now there's about 116% short float. Let's say just half of those cover. Let's say they covered we're going to be very minimal with that numbers here, just to kind of show the magnitude of what's going on here. Let's say just half of the short flow is covered. Let's say 80%. Now let's look at the outstanding shares. Right now, the outstanding shares on GameStop are 69 million. Let's take just half. Let's do about a quarter of the highest ask that we saw, right? Or just to be as conservative as possible, let's do just a fifth of the highest ask that we saw. On some of these, there was upwards of 2,600, etc. So doing half of that will kind of let us see what the maximum pain threshold could be in a short squeeze. So let's say that the maximum price for that was 1,500. Well, if we do just 70% of the outstanding shares being covered at a $1,500 stock, that is a loss of $73 billion. Now, that's not even including the short interest fee that they'd have to pay. That is assuming that there will be enough shares on the market for them to cover 70% of their position. That will assume that many of the retailers and many of the people holding the shares will liquidate a bit of their portions, because brokers have to have a certain amount of shares on the books as well, that they don't sell off, etc., etc. A $73 billion loss to them would just be if only 70% of the share float gets covered. Now, I know we often hear these astronomical numbers and we might kind of become desensitized to what they mean. But those $73 billion Those hedge funds don't just have that in their pockets. They are other billionaires and other wealthy people's money that they're managing. Now, I want you to put yourself in their shoes. I want you to imagine that you are maybe someone who has a net worth of 50 million, 100 million. Let's say you have a net worth of 5 billion. And you gave Melvin Capital a fifth of your net worth to manage, and they blew it all, right? Let's say you gave it to a different hedge firm, right? Because $73 billion would be in losses just trying to cover the stock, right? That wouldn't even be considering how much they've already lost, right? $73 billion will be leaving your pockets for you to never be seen again. These investors, these people managing this amount of money, will never work trading again if they have to take a loss of this size on their books. We can even see through public records, right? A great chronicle of all the events that have been happening is honestly Wall Street Bets, because let's be honest, this stock, this story, the history of what this squeeze has been and what the whole social pariah behind GameStop's movement has been is well chronicled on WSB, because it started there organically. So you can even look at documents that many people have posted there, that Melvin Capital was absorbing a 30% loss just as of this Monday, and that was when GameStop was a fourth of the price it reached at today at its peak, right? So now that you've considered just how crazy the losses can be, at a minimum of about $70 billion, it kind of puts into perspective. This won't just affect Citadel, it won't just affect Melvin, it'll affect the brokers who, when these firms can't pay them back, will have to absorb these losses on their books. Now you may be thinking, listen, these brokers, they have tons of money, they can definitely handle this, right? They handle billions and billions of dollars, and they must have those billions and billions of dollars in assets. Well, unfortunately, no. What I'm going to be doing is I'm going to be including a link down below to an interview on CNBC by IBKR, the IBKR president. He's the leader of their brokerage firm. And he goes on to state that other brokerages, they do not have enough liquidity to cover a short squeeze. Meaning that if a squeeze does happen, they do not have enough money to handle paying off these other firms, especially if they get margin call. And I'm sure many people saw that today when a lot of brokerages, especially Robinhood, I think that's the most famous one that people are talking about right now, they started selling people's shares who were holding it on margin because they were getting margin call. Right? These brokerages do not have enough assets to cover this kind of loss, especially if a squeeze happens. This is not coming from me. This is not coming from people posting on the internet. This is coming from someone in the know. The chairman of Interactive Brokers. He states that other brokers, and he knows probably more than anyone else, honestly. These brokers, they obviously know what their financials look like. They obviously know what their competitors' financials may look like or have the closest resemblance to knowing. He stated that these other brokers do not have enough cash on hand, enough assets to cover this type of loss. So to put this into perspective, if this squeeze happens, it's not just these hedge funds that are going to be affected. These brokers will take an immense loss on their books, and don't take it from my word of mouth. Don't take it from what you hear from me. Please watch that video. It's an interview on CNBC. I'm linking it down below. It is incredibly insightful, and the stuff he says, if you're not in the know of what's happening with the GME squeeze, it's kind of frightening to consider the amount of losses these companies can take. That being said, once you start wrapping your head around that and the sheer amount of loss that can incur, not just to Robinhood but other brokers as well, you'll see why they're limiting buying of GME. They only want people to sell, because once there's enough liquidity in the market, once there's enough shares for these shorts to cover, then they don't have to pay those astronomical prices. And then they inevitably, yes, while taking a loss, it'll be much less, $72 billion. You can also just look at how many times the stock is being halted. At moments today, and you can pull up a chart with indicators, etc. Or go to the New York Stock Exchange website to see what times GME was halted. And it was halted during price fluctuations that weren't even greater than 4 to 5%. This was being halted on purpose, so shorts will have time to cover during the downside of these halts. The disaster, the sheer scale of what would happen if these brokers were to get margin called is kind of crazy. So that's why Robinhood restricted the ability for people to buy GME and other heavily shorted stocks. There was a liquidity crisis going on. And I'll be including a few links to articles, some interviews, etc. down below. Some good D&D people have posted with good sources. And I highly recommend you read this, because this is something that hasn't really ever occurred on the markets before. At least not, dare I say, since the housing market, when there wasn't enough ability to cover the sheer amount of losses that would be absorbed by financial institutions who are shorting, going long on the housing market. So Robinhood had a vested interest in protecting themselves and their clients so as not to go under, as well as other brokers. Now, many people may see that as just being not just speculative, but maybe just kind of a shot in the dark. Well, if we direct our attention to WSB, you will see a few posts from people who claim to work at Robinhood. And while yes, you should always take it with a grain of salt, they've gone through verification with the moderators of WSB, who understand that if they're to post negligent information like this on the forum, there can be severe consequences for not just the forum, but the moderators themselves. So they're obviously doing it with verification themselves. These are people who claim to have worked at Robinhood or are currently working at Robinhood, and are saying that Robinhood is allowing Citadel and themselves to take massive short positions right before that they announced that GME would halt trading on their brokerage. That would imply a huge insider trading scandal where Robinhood, Citadel, etc. expected and orchestrated the drop of GME shares so that they can have enough money to cover and also dig themselves out of the huge loss that they were going to take if GME was to rise. There's some proof that's recorded and shown for these orders, and that they were done by large institutions like Citadel and Robinhood, at least alleged to. And once again, these are linked down below, so please check this out and take a look for yourself, because I may be interpreting this very differently from how you may interpret this. So you may have a more concise and maybe logical outlook on this. So please read all these sources, read everything I'm mentioning down below, form your own opinion as well, because we can't just keep talking into a echo chamber where we're just repeating ideas off of each other. We have to kind of use a little bit of logic and have different perspectives on the situation. But massive short positions were bought, and there are a few credible sources as well, aside from people who work at Robinhood, who are stating publicly that they have information that Robinhood, Citadel, and the lot buy short positions on GameStop exactly when they halted buying. And obviously, if people aren't buying, the demand is going to go down rapidly. It will cause a panic sell and cause massive short ladder attacks. Now, there's much more to cover, but unfortunately, I have to edit this video. I have to get it posted, and as well as I have to do a little bit of other work. What I'm trying to point out in this video is that the measures that Robinhood took, as well as these other brokers, halting a ticker from not just trading, but from being bought, positions to be sold so as to be advantageous to their partners and to these firms. The fact that they had to take measures like this shows that there is something incredibly scary going on in the background. Now, people like you and I, we knew that doing something like this would obviously be very bad for the history and the PR of Robinhood. And Robinhood obviously has hundreds of millions of dollars. They have a PR team. They have people way more professional, way more experienced, way more skilled in handling public relations than you and I. And yet they went through with this move. So it shows that they didn't do this out of the best interest of the people trading on Robinhood. They did it out of the best interest of their partners, of themselves. They knew they would take a huge hit on a PR perspective, but they did it regardless because it's either that or, to keep it short, bust. If I were to summarize this, it would be with just this following statement. Over the last 2 years, we've seen this country very divided. Now, I don't want to go into politics, but this country has been disagreeing on a lot of issues, both the left and the right. People with different economic views, they've been disagreeing down the line, and this country, if we're being honest, has been very divided. However, I want you to check your local representatives' social media. Check your senators, your congresswomen's, your congressman's social media. I want you to check a few celebrities' social media, see what their opinions are on this. And you'll see that the overwhelming majority, be it people from the left, people from the right, people of wealth, people of minority, people of different classes, different roles in society, different political alignments, different economic alignments. Many people on social media are incredibly outraged on this. They're stating their opinions of legal action. And as we speak, the Department of Justice has actually launched a probe into Robinhood as well as Citadel. When a situation is so grave, so dangerous, that it's able to mend broken lines, have politicians on different sides agreeing, have the Department of Justice get involved in one day, it shows that what's going on is not just illegal, but something to be concerned about. What may have started as a good stock pick, as someone suggesting to people on a forum, hey, maybe we should get in on this value play, the stock could appreciate maybe from $5 to $10. What started as something as simple as that has gone on to expose just how corrupt, how fundamentally flawed the financial system is. It's not only got the attention of regular people, it's got the attention of politicians, people around the world, of economists, of people in the entertainment industry, everyone. And they're all, on one way or another, agreeing that there has to be something done about this. The acts that these brokers committed today, in collusion with these firms, is heinous. And I'm not saying that action will be taken by the government, because we've seen things like this go under the radar before. But what I am saying is this is a larger scandal than most people are understanding. This is something on the level of financial bankruptcy. I'm not saying it would tear down the entire American economy, no. I'm saying that many banks, many institutions would lose an incredible amount of money, so much so that they very, very publicly broke the law. And many people are noticing. These are unprecedented times on the market, especially with what the Federal Reserve is currently doing, allowing multiple bonds and securities to be bought up in order to artificially inflate the market. What's going on with GameStop now is much larger than just a short squeeze. It's seeing, does the financial system that we've created on the stock market, is it viable? Is it something that can be sustainable? And is all the taxpayer money that we're paying, is it going towards something? Will these people be regulated? Will anything be done about what's happening and what currently has happened? About what's currently happening and what has happened? We're going to find out. These next 2 days will be very interesting. Let's pay close attention, because at this point, it's not just about GameStop. It's about the financial integrity of these brokers, these financial systems. Thank you for joining us. We'd like to hear you guys' opinions. Please comment down below and let us know what you guys think, or send us an email, interact with us on social media. Please review all the information I'll be putting in the description down below. I know once again that this video may seem very unorganized. It's mostly off the top of my head. I've taken down a few notes, of course, but I just had to get the video out there because this is just something very incredible that's been happening in the financial realm that impacts a lot of people. So I want to hear you guys' opinion. We want to see what you guys have to say. And if you stuck with us this far, thank you. And we hope to be uploading more content for you guys. Have a great day and stay safe.